comments contained in this podcast do not constitute legal advice. The opinions herein are the opinions of the speakers and not the official opinion of the Hodgson Russ Law Firm. Hey there, tax fans. Welcome to State Tax Talks with me, your host, Joe Tantillo. I'm a tax attorney at the Hodgson Russ Law Firm looking to explore the nuances of state and local tax law. Here on the show, our goal is to keep tax informative, simple, and fun. So if you're ready to talk tax, turn up the volume and dive into this episode of State Tax Talks. Hey folks, welcome back to another episode of State Tax Talks. I am your host, Joe Tantillo, and I am here once again with my colleague and friend of the pod, Joe Endres. We have been talking about abandoned property and New York's rules for reporting abandoned property, compliance, etc. Today, we're going to pick up that conversation in part 2 of our abandoned property series. We're going to talk a little bit about audits. We're going to talk a little bit about record keeping, and we'll talk about some of the voluntary disclosure rules as well. So we're going to jump back in with that right now. Enjoy the second part of this conversation. So let's start to talk more about these reporting requirements for the businesses. So generally speaking, what are the reporting requirements for unclaimed property?
Okay, so first, you have to file, if you have abandoned property, you have to file an annual return. But only if you have abandoned property. If you don't have any abandoned property, you don't have to file anything. Some states require you to file what's called a negative return, which is a zero return, but New York State does not. So it's an annual filing obligation. And the other thing about New York State is that there is no de minimis amount, meaning that if, little Joey Tantillo has, $10 or $7 or 50 cents left in his bank account from his paper route money that he had. By the way, were you too young to have a paper route? Did they still have paper?
I think I just missed the cutoff for that. I was definitely, I remember physical papers getting delivered on Sunday when I was very small, but it was all digital by the time I was in middle school, high school.
Oh, okay. Well, Joe Endres had a paper route and had a bank account with paper route proceeds in it. And just think, there might be a few dollars left in that, and that there's no, de minimis amount that below which you don't have to escheat the money. Mm-hmm. Even if it's just a couple cents, you still have to escheat that in New York.
Right.
So we're talking about any type of abandoned property, any amount has to go over to the state with respect to an annual return, which for general business corporations is filed on March 10th of each year.
Got it. And, you mentioned that we were going to focus on general business corporations for today, but, what other entities might have a reporting requirement in, under the abandoned property rules?
Yep. So banks have a final report day of November 10th. Utility companies have a final report due date of October 10th. Broker-dealers are also March 10th. Court funds are April 10th. So, there's a bunch of other categories.
Right. Is there an overarching definition for, being an entity that holds the property of another that's in the law that kind of gives guidance to give you some indication that you might need to keep this in mind?
It's really more the definition of the property, right? So if you're an insurance company, you're holding insurance proceeds.
Right.
So here, and this happens all the time, again, the comptroller publishes statistics, but the single biggest contributor to the abandoned property fund every year are banks, 36%. The next biggest are general corporations at 28%, and the third of the big three are insurance company at 17%. So, sometimes people think, well, how come that's such a big part of abandoned property? And think about it. This frequently happens where a spouse buys a life insurance policy, and that's the spouse that handles the finances for the couple and just never tells or, doesn't make clear what this policy is, how they got it, when they got it, what you have to do when I die in order to, file a claim. So there's a lot of life insurance proceeds that go unclaimed every single year.
Right.
And after a certain amount of time, that has to be paid over to the state. But that company will have to be subject to the insurance company rules because it's, that's what it's doing. That's
right.
Business.
So let's go back to these reporting requirements. So, basic due diligence rules for a company with a reporting requirement. Let's start with, what kind of information do you need to include in these annual abandoned property reports?
Yep. So there's two returns, or I guess components to the return. There's a kind of cover sheet that details all the information about the holder, who the holder is, has someone sign from the business that, kind of certifying the accuracy of it, and then gives a quick, table of, what is included in detail. It's kind of like the cover sheet where the other part of the return is all the detail on the individual account. This aggregates everything and says, this is how much cash I'm reporting. Mm-hmm. This is how much I'm reporting in stocks or, whatever other category you have.
Right.
And then the second part of the return is the detail for each individual account. And that's where, if you have it, you give the information about the owners of the property. So this is the information I have in my business records about that employee that worked for a few hours on their last day and never cashed the check. So here's their name, here's their social security number, here's their address, here's the amount of the property. And that's primarily what goes into the second part for each individual account. Now, you are allowed to aggregate anything under $20 in New York, so you don't have to individually load them all. Again, another little way that New York State might not have to pay out abandoned property, but there is aggregation of data that's allowed under $20.
Do you have to also provide information on, whether and how you've actually contacted the owner about the property?
Yeah, that's a great question. And so that goes to what's called due diligence. Mm-hmm. Again, this is a consumer protection law, right? The goal of this is to reunite owners of the property with their property rather than keeping it in the hands of the holders. And so for general business corporations, there is this due diligence requirement where they are obligated before remitting it to the state to try to reach out to the owners of the property to say, hey, I've got this property. If you don't get in contact with me by such and such date, I've got to remit it over to the state. So it's kind of like a last-ditch effort to make contact. Mm-hmm. And there you have to do that. Every holder of abandoned property has to send a first-class mailing at least 90 days prior to the date the return is filed. So this would put it at December 10th for most general business corporations. So 90 days before, you got to send a first-class mailing saying, hey, if I don't hear from you, I'm sending this over to the state. Contact me and I'll send it to you instead. And then if the amount of the funds are above $1,000, you have to send a second mailing 60 days prior to the return via certified mail, basically saying, again, because of the amount due, we've got to do a second mailing, a little more formal, and hey, 60 days left, or I'm going to shoot it to the state.
I actually did experience this recently. You joked about, old bank accounts with paper routes. I actually did have an old bank account with some communion money in it that they had to notify me about because I didn't even know the account existed. Like my parents had opened it for me when I was 7 or 8 and put the communion money in and then kind of forgot about it. And
so did you go through the process? Did you claim the funds?
So I did claim the funds. Luckily it didn't get all the way to being abandoned, but I got the 90 days notice that they were going to close the account and send it to the state if I didn't respond. And it was actually a little bit of a pain to claim the money because when I found out about it, I was like, I wanted to claim it and then close the bank account. And they made it a little bit difficult. I think they wanted to hold on to it longer. Once they found out that I was alive and well, they were like, well, just, keep the money with us and keep the account open and all that.
Well, first off, I have no idea how this wasn't abandoned years ago, if this was first communion money. I mean, I don't know when you made your first communion, but that's actually a common refrain that I hear when trying to claim money, not from the individual holders, but from the state. Most holders are anxious to get the money off their books because it's just another compliance obligation.
Right.
But when you go to the state to get it, well, you've got to prove that that's your money. And to do that for accounts that are years or even decades old, or perhaps were held by your parents and they passed away and now you're their heir. Demonstrating proof of ownership in those type of situations can be onerous.
I had a heck of a time too, and I can imagine why it would have been tough to get from the state, even proving who I was to the bank for an account that was set up that long. Like there were no security questions, there was no PIN, there was no email address associated, all the stuff that you have now with a modern bank account. It was just like, somebody filed a paper application back in the 90s and that was that.
Yep.
Well, that's my little story about how this issue impacts me as an individual in particular. So for you listeners out there, you never know. It could be you next.
You know what? The next time I'm on the podcast, we're going to make a little bet right now. We're going to keep it interesting. I want you to go to the comptroller's website. And on the website, you can do a search for your last name, your first name. You can put in what you want. But I bet you there's more than that out there. Okay. I bet you have other abandoned property, and you should run a search that actually made it to the state.
Yeah.
And so the next time I'm here, we'll see if you had any abandoned property on the comptroller's website.
I'm definitely going to take a look, and hopefully there is some.
I actually meant to do that before I came here, and I just ran out of time because I would have liked to have been like, Joe, you got
that would have been awesome. All right. Well, I think this is as good a time as any to segue into the next part of this discussion, which is about the audit issues. We've talked a little bit high level about what abandoned property is and how the due diligence works and the requirements, et cetera. But this is a podcast on abandoned property audits. And I'm very interested because, again, we talked about how this is not even a tax issue to begin with, and I'm so used to dealing with tax audits. What does an abandoned property audit even look like? Where do you begin?
So let me start with a little factoid here. Several years ago, the Council on State Taxation, COST, right? It's a nonprofit that kind of, runs analyses of various state tax laws and, policies, et cetera. Well, they did a nationwide multi-state review of every single state's abandoned property law. And they gave each state a grade based on the aggressiveness of their law. The more aggressive the law, the lower the grade. 3 states got the lowest grade, according to COST's analysis. New York, Delaware, and Mississippi. They each got a D-.
Interesting.
Now, how did COST do this? What does this mean? And the reason I'm bringing this up is because it gives you a flavor for what the audits can look and feel like.
Right.
So you got a point for every aggressive position that the state takes or every aggressive provision that the law has in it. Mm-hmm. So, for example, in New York, you got a point if you did not have a statute of limitations, right? So New York this isn't a tax. Normally in the tax world, we're used to dealing with if you file a return, you have 3 years, sometimes a little longer if, there's some substantial understatements or if there's, fraud or something like that. But there's a statute of limitations beyond which oftentimes the state can't come after you.
Right. Major protection for
protection.
Taxpayers.
That's not true of abandoned property, at least in New York, even when you file a return. Mm. So there is no statute of limitations in New York. Second point, does the state allow contract auditors? Well, what the heck is that? Well, we do tax audits all the time, right? And we're used to dealing with auditors from the New York State Department of Taxation and Finance.
Full-time state employees.
Full-time state employees, exactly, who do not have a financial interest in the outcome of the particular audit, right? Well, that's not true of contract auditors. Contract auditors are companies that can come in and conduct an audit on behalf of the state, and not always, but frequently, their compensation is based, at least in part, on the amount that they collect. So the auditors in these contract audits can have a financial stake in the outcome of the audit. Talk about, not exactly a level playing field.
Yeah, that's like the imaginary fear that all our clients have that's happening behind the scenes in the audits we're dealing with normally. That's actually a thing with abandoned property audits.
Exactly. Another point, New York doesn't have any business-to-business exclusion. What do I mean by that? Well, again, this is a consumer protection law. Mm-hmm. So many states exempt from, the obligation to escheat transactions between businesses. Mm-hmm. Now, this isn't retailer to consumer. This is business to business. And
right.
The idea is that businesses are on similar footing, and we're not here trying to, protect the consumer. So we'll just ignore all of those transactions. So when a business buys something from another business, that in many states wouldn't be subject to escheat, but it is in New York. So no business to business exclusion. And then finally, New York can have pretty onerous penalties and interest when there's a liability. It's $100 a day for every day that the abandoned property return was not filed. And that compounds, right? So if you didn't do it for 1 year, that's $36,000. Another year, $36,000. The next year, $36,000. Then each year has its own kind of running tally. And then
with no statute of limitations.
With no statute of limitations. And then finally, on top of that, there's 10% interest that gets applied to the liability. So, or there can be. So that's kind of the parade of horribles that got New York State the lowest grade, according to COST's analysis. And all of those can come into play, during an audit.
Well, that's one of the more horrible parade of horribles we've talked about on this podcast. With that in mind, why don't we talk about some of, the common audit issues? And I've split this up. We'll talk about, maybe some common factual issues, then we can talk about some common legal issues that arise during these audits.
Okay. So, I guess during the audits, the 2 biggest factual issues that come up is, can you prove your numbers, right? And the reason this gets difficult is because you may be able to prove your numbers for, say, the past 2 years, 3 years, maybe 4 years. But, most businesses keep records for that amount of time. Mm-hmm. But remember, abandoned property doesn't even become abandoned for, in most cases, 3 years.
Right.
So we're talking about numbers from years 4, 5, 6, mm-hmm. because that's what's actually abandoned.
Right.
And can you prove the fact that, you did or did not have abandoned property going back that far? And then even if you can, if you haven't been filing abandoned property, there's going to be usually as part of an audit an extrapolation because, again, no statute of limitations. Mm-hmm. So even if you have property for years 4, 5, and 6, do you have it for years 13, 14, and 15? Right? Because if you haven't been filing and you have abandoned property in any of these periods, the state is going to say, okay, but you don't have records going back the full amount of time you've been in business. So what we're going to do is assume that for the period during which you do have records, that's representative of every year that you've been in business. And we're going to take any liability we find. It's kind of like a sales tax. Yeah. This frequently happens.
Right.
We're going to take any liability we find in the period for which you do have records and apply it to every kind of older year. So the liability can balloon and you can be at a real kind of deficit being able to defend it just because you won't have records going back that far.
Well, that complicates matters, certainly. So that's a common factual issue. How about common legal issues that come up?
Yeah, we often get into fights about, does something qualify as abandoned property? Is this abandoned property? Is the amount final? Is the liability, the right to the property, is it fixed and determined? So those would be some of the more legal issues that come up. Similarly, a question can come up, well, is it abandoned if I fielded a phone call from the customer or from the business 2 years ago and I have a note in my file saying, yeah, the customer called up and said, yeah, they still do want to keep that customer credit on file. So that's not abandoned anymore, right? There was communication. And that can be a real question because usually in order to restart the abandoned property clock, there has to be a written communication. A verbal communication usually won't restart the clock. So you have to be careful with, we can get in arguments about, is something still abandoned if there's been some type of communication? Or what if I just move money between accounts? That's activity. Is that still abandoned? Usually not.
Right. So do you think that generally speaking, these audits fall more in kind of the first camp or the second camp? I suspect that probably this is more typically an exercise in like good record keeping than it is getting into, the debates on the legal questions.
Definitely the first camp. Every audit is going to have to deal with those issues. Not every audit deals with the, does it qualify, et cetera.
Right. Okay, we are going to pause things again. This has been a thrilling conversation. So thrilling, in fact, that we need to pick things up next time with part 3 of this series, which will bring our discussion to its thrilling conclusion. Until that time, this is State Tax Talks. I am your host, Joe Tantillo. We'll see you real soon. Thanks for joining us for another episode of State Tax Talks. If you're interested in listening to more episodes, we're available on all platforms where podcasts can be found, including YouTube. If you enjoyed this episode of State Tax Talks with Joe Tantillo, please give us a 5-star review on your favorite podcast platform. And if you're in need of a tax professional, you can contact the tax attorneys at Hodgson Russ. Go to www.hodgsonruss.com for more information. And until next time, I'm Joe Tantillo, and this is State Tax Talks. Catch you later, tax fans. The comments contained in this podcast do not constitute legal advice. The opinions herein are the opinions of the speakers and not the official opinion of the Hodgson Russ Law Firm.